when it comes to forward-looking indicators, Jeff and I often discuss what's happening in the money markets, in the shadows. And, well, because that often leads real economic activity, commodity markets, capital markets. But I would think if we were to pick one item from the real economy that's forward-looking or is most popular and perhaps best, most representative, Jeff, you correct me if I'm wrong, but I would think it would be the Purchasing Manager Indices. And that's what we're going to discuss with Jeff Snider, head of global research right now. We're going to discuss what's happening in the United States, in China, and I'm going to give a world overview as well. Jeff, part 3 of our show, ISM's nasty little surprise isn't actually a surprise. That's the title of your July 6th piece, where you talk about ISM, IHS, PMIs.
Yeah, there was a nasty little surprise that wasn't really that much of a surprise, because last week, or the week before that ISM data came out, we had the payroll reports. And the payroll reports for the month of June were at the headline establishment survey seemed like everything was really good because it had bumped up into a big number. In the private side, I mean, it was elevated a bit by government hiring or lack of government layoffs because seasonally adjusting and things like that. But still, it was a really big number that seemed consistent with an economy moving along and the labor market moving along really well. But the household survey, which is sort of the bastard twin of the current employment statistic numbers, the CPS or the household survey showed actually a decline in the month of June. Now, the household survey isn't adjusted as much as the establishment survey, and it is known to be quite volatile, but still, it has been moving lower over the last couple of months to the point where in June, it's the households that were surveyed, which is some 80, I think it's 40 or 50,000 households that get surveyed. The tabulated results from that survey said, we're starting to see maybe a softening of employment to the point where there's maybe a decline, maybe just a low number of growth in the month of June, which was the exact opposite of what's going on in the establishment survey.
I suppose I pulled this graph up too early. Tell us a little bit first.
It's perfect.
I mean, what you're describing is, earlier we were talking about multiple independent points of view and taking one isolated piece of evidence and see if it matches up with others. And that's what we're going to do. But first, let's talk about the PMIs. There's the PMI that we all hear about, the headline PMI number. I know I eagerly await it in the mornings when they're released. I've got a lot of money riding on it, a lot of bets. But guess what, Jeff? There's like 5, sometimes 6, I don't remember, underlying components, prices, employment. What else? New orders. I don't remember all of them. And that's what we're going to discuss one of them.
Yeah, and it's there used to be just one PMI too. There's the ISM's manufacturing survey, which goes back into I believe in the 1960s, which was really the granddaddy of all these PMIs. And then along came market and IHS market, which is competing with them. And now there's not just manufacturing. Of course, we have the services component of the economy. So now there's an ISM manufacturing, ISM services, there's an IHS manufacturing, IHS non-manufacturing, and all these other things. And of course, they got together. Now they're putting together composite PMIs so that we have almost, it can be at certain months an overload of information. And sometimes it's tough to parse what's really going on with all of these numbers and indexes and things.
And so you, of course, I was going to say nothing better than to do. But that's not fair. That's not fair, Jeff.
No, but it's true.
How do I say that you have the time, you find the time to parse that information and delve down into the employment PMI?
Well,
and what would that be? That would be, I'm sorry, Jeff, just very quickly, people may not know. So it's a survey. You call up somebody and you say, what do you think about the future with respect to prices, orders, et cetera, in employment? And they say more, less, or about the same. Is that right?
Yeah, it's a question. What they're questioning on are these various individual pieces. Employment. Are you hiring? Are you cutting workers, or about the same? Are those? That's really the questions that they're asked. And they put together a a statistical number that's where 50 is the dividing line, which between more people saying things are growing, therefore the PMI is going to be above 50 or the component's going to be above 50, versus if more people are saying they're cutting back or things are falling, then you would expect that to be below 50.
Okay, and then for the employment section, that's the nasty little surprise, because was the headline number positive, Jeff?
Well, the headline number for services actually declined on both IHS Market as well as ISM. And so it wasn't, I mean, the number is still very high, like a lot of the PMIs are, but it was somewhat concerning that it dropped almost 4 points. But I think the real negative surprise, which wasn't a surprise, embedded in it was the fact that the employment component, the employment PMI itself, fell below 50. Now, it wouldn't go far below 50, but the fact that it's dropped below 50 at all, and it wasn't just the ISM services PMI, it was also below 50 for the manufacturing PMI as well. So both of those for the month of June said, maybe the labor market's not strong. Again, because this is manufacturing as well as services, and you can see the clear, the peak earlier this year and then maybe some slowing. And when you plot it out that way, it looks a lot like the household survey that we just talked about here. And the household survey, again, yes, that's very noisy and whatnot, but there is a correlation and relationship between what goes on in the household survey and some of this PMI data, including the employment data. Mm-hmm. Not just recently, but also in 2019, for example, there was definitely a slowdown there. And again, toward the end of 2019, even after the Fed's rate cuts and all the repo stuff that went on there, which was consistent with the PMI data. So we're starting to say, these are very different data points. You have the BLS's household survey, you have the ISM's services and manufacturing PMIs, and both of their employment components said kind of the same thing that we're seeing repeated all over the world. We just talked about in the previous episode about Germany. Maybe the recovery, the reopening, reflation, maybe the best days are behind us. And we're starting to see a lot more indications of, not necessarily recession, nothing that bad, but perhaps just slowing down.
Well, that's exactly where I was going to go next, because you have a sensational line in this paper, Jeff. This doesn't mean recession on the horizon. Much worse. Jeff, what can be much worse than recession?
That we're stuck in the same economy as we've been in for, 13, 14 years now. It's that, this was supposed to be something, as bad as the COVID and coronavirus and the pandemic and the recession related to it was supposed to, the idea has crept in that the response to it has been so good and so huge and so big, it didn't just get us out of the coronavirus problems and the rut and the economic recession. It got us out of the post-crisis, the post-2008 rut. The governments had done too much. It was going to be inflationary for the first time in decades. And yet here we keep seeing another set of data that says, yeah, there was a temporary burst of activity that related to these massive government interventions, particularly in the United States with Uncle Sam writing checks to both businesses as well as consumers or former workers. But then what? But then what happens after the checks wear off and the interventions start to recede? And time again, we're getting these indications which say, well, we had that temporary intervention, and now we're right back into the same shape as we were before COVID ever happened, which was not very good at all. We have this double problem. We have a COVID problem, a deep recession of 2020 we really haven't gotten out of yet. And then not got out of that recession, the economy that we're left into is the same one as preceded the recession last year, which is, not a good economy at all.
Here, reading from your report, Uncle Sam came in with huge checks, but then what? And I'm going to disagree with you a little bit about what you said, that people thought we were getting out of the 2008 rut. And maybe I'm cynical, Jeff. I want you to analyze me as if I was on the couch right now. Am I being too cynical, Jeff? I don't believe that the people in power, the technocrats, the politicians, I don't think they know that we're in a rut since 2008. Because they wouldn't have stopped with the checks. They would have reacted as if this was a Great Depression, and we need FDR style programs. I think it is my sense that they felt we were coming out of whatever it was, that downturn that took a little bit longer than normal. And then Donald Trump was elected, and he was very orange. And that's why we had these global trade wars. And then we had the COVID come. So I sense that people, the economists, the media, they believe that these were idiosyncratic accidents. We had an orange person that didn't like trade, and we had the corona. But that's all gone. We have elected President Biden now. The corona's behind us. So all we need to do is provide a little bit of stimulus, just like we have since the post-World War II period, the plucking model with Friedman, the Keynesian stimulus. That's what's going to do the magic. I don't think people in charge have any appreciation of the depths that we're in. Am I cynical, or are you talking to people in charge that say, oh yeah, we know we've been stuck for a long, long time?
It's kind of both. But again, the idea is mean reversion, right? That's essentially what you're talking about. That, yeah, we've been stuck for a very long, long time, but eventually we'll go back to where we're supposed to be. That the Friedman's plucking model will hit potential or whatever that is. And yeah, I think there's a lot of serious people, unserious people, important people, people with, the best credentials who believe that eventually, if we just clear up enough of the obstacles of these accidents, as you call them, the economy will on its own get back to where it's supposed to be. And I think when you look at the opposite of that, certainly the view from the bond market and the money markets, what they're saying is yes, except that reverting to the mean is not the same mean as the pre-crisis era. Reverting to the mean simply means we go back into the same lethargy, the same rut that we've been in for 14 years, and that these are not obstacles or accidents. They're simply the way everything is. That the economy is held back by something time and time again. We can put labels on what each of these things are, but it's the same thing, which is a broken monetary system. So yeah, it is reversion to the mean, but what is the economy's mean? And I think it's different in the post-crisis era than it had been before 2000. I don't think there's any question that's the case. That's what all the data says, not just in the United States, but all over the world. The growth paradigm has been broken, and it broke right around October 2008, which kind of narrows the list of suspects down greatly. And nothing has been the same since then. And as we've talked about before, economists, particularly neo-Keynesian economists, don't believe in unit roots or permanent shocks, so they continue to wait for this reversion to the pre-crisis mean when all of the evidence and the data and the market verdict is uniform that the reversion to the mean is only ever going to be the post-crisis mean, which is something completely different altogether. And that's why we say inflation was impossible to begin with. Even as we recovered from the coronavirus recession, reversion to the mean wouldn't be pre-crisis growth and possible inflation that way. It would mean we're going to go back to where we were before we started the coronavirus.
Let me just footnote your statement there when you were saying inflation. By inflation, you mean permanent, pervasive increase in general prices due to a ubiquity of money, not a supply and demand, logistical supply chain disruption, price increase like we're seeing now. True, right? Because people are watching. They're saying, inflation, my lumber's up, and all manner of things are up.
The CPIs in the U.S., which, again, it's the U.S. It's just U.S. CPIs. You look around the rest of the world, it's not really that bad at all. In fact, it's really interesting that the U.S. CPIs and U.S. inflation data have gone so far ahead of Europe, for example, when for the last couple decades, inflation has been in lockstep in both of those places, which is indicative of idiosyncratic factors which are not inflation. So to me, what's happened over the last couple of months is a temporary price deviation, which is not the same thing as inflation at all. Yes, I know prices are up in certain places, but it's not monetary inflation. It's not the Fed printing money. It's not the money flowing through the real economy, because the real economy is in real trouble. It's stuck in real trouble. And that's really what we're saying here, is that once we get past all of this temporary stuff, the price deviations, the government checks, whatever else has been responsible, vaccines and pandemic sentiment rising as it should, legitimately rising, people being much more optimistic as they should be. Once we get past that temporary, that short-term trend, what is the mean reversion? What does the economy really look like after all of those things are done? And I'm afraid people are going to be shocked to learn, when they shouldn't be, that the economy is maybe even a little worse off than the pre-COVID era, and not in any way better off.
I was thinking that we might want to do an episode on what you just mentioned, that the United States CPI, PCE numbers are high, whereas in other countries we're not seeing that. But we may not. We haven't when you wrote that report, and we may not get to it. So to your audience, just rewind that again. I think that's a very interesting point. We have an outlier in the United States when it comes to inflation. And so one should question the outlier versus the general background context that we see. Jeff, in your article here, you say that these numbers that we're seeing, we shouldn't be seeing them so soon after a recession unless we're heading into a double dip or something. And that's why earlier you said you don't know if you should even call this a reflation. After a recession, you should see a strong bounce back. You shouldn't see this sort of weakness. And
strong, uniform, ubiquitous, unambiguous. I mean, recovery is something that you don't question because everybody just knows. I mean, you look at any data point and it says, yes, things are good. We should never see this kind of ambiguity.
In your article, you talked about China. I suppose we don't have too much time. We don't want to go too long. But you talked about China and their PMIs. Not super, right? Basically, we can't.
Same point, right? We had a temporary burst reopening in China, which, remember, the Chinese went into recession before everyone else. They went into lockdowns and everything else a couple months before everybody else. So the Chinese economy is a little bit ahead of the curve. And what we see from the PMI data, as well as the real economic data, retail sales, fixed asset investment, and industrial production, which we've talked about before, the Chinese economy is not doing well at all. And it may have peaked in November of last year. So we're 6 months or so into a slowing trend from what wasn't really much of a recovery to begin with. And that's consistent with what we're seeing in the U.S. data, which the U.S. data was more distorted by the U.S. fiscal interventions and things like that. But overall, it's the same sort of trend. After we get through those interventions and those temporary positives, what do we see? We see the same kind of potential slowdown developing that has already developed China, which just today we learned that the People's Bank of China has cut the RRR, which is, as we've talked about and I've written about for many, many years, that's not stimulus, that's a warning. So the Chinese are saying, yeah, things are getting serious over here in China. The government has been consistent in saying, this is it. This is as good as it gets, and it's not that good. And now here we have an RRR warning, which is the Chinese saying, yeah, we might see not just a slowing in the economy, it might be getting worse than we even think that what it would potentially could be right now. So there's all sorts of data all across the world and all these big economies that say U.S. inflation, complete outlier, bond yields falling, rolling over in Germany and all these other places that suggest forward-looking mean reversion. As we talked about, mean reversion doesn't mean something good. Mean reversion might mean something bad, and potentially it could be it could be worse than it was before the pre-COVID or before the COVID recession too.
Last thing from me, Jeff. You just mentioned all over the world, and I was able to put together a 40-some PMIs for June from around the world and compare them to May. And the results were that most, and I'm just talking about manufacturing right now, everyone reported that they were above 50 and they expected to see continued expansion. But for June, it was less broad, less enthusiastic than compared to May. And I'm going off of memory now, but the world average was like 57.5 compared to 56.3. No, I messed that up. So now it's 56.3, whereas in May it was 57.5. Basically 1 point lower for manufacturing.
Right, Emil, that doesn't seem like a big deal, but it really is. It's a big deal in that we're not supposed to see things start to slow down. Any of these kinds of indicate we're not supposed to see things, the conditions slowing down this soon. You wouldn't expect that if this was a real recovery that finally got its legs underneath it, with the economies reopening more completely across the world, especially Europe. We would expect acceleration. We would expect it to be unambiguous. We would expect it to be ubiquitous and uniform, and all these other adjectives we could come up with that suggest what a recovery actually is. And the fact that we continue to see negative indications pile up, and then, of course, the bond market becoming more and more pessimistic. I mean, forget inflation. Even, in the TIPS market, inflation expectations are falling again. The markets are saying something may not be right here. And then now we're getting data that comes in that says something may not be right here. Things that were supposed to be going right aren't. And that we're reaching maybe the limits of what that temporary intervention could have achieved. And now what? What does everything look like once that temporary stuff wears off?
While you were talking, I showed another graph with red dots, and that was services. And services is mixed. Not everyone, but mostly everyone is reporting continued expansion, so everyone's above 50. But the results were mixed. 10 countries reported that they were worse off in June than in May, while 9 said that they were better off. So kind of a neutral in terms of acceleration of good news, but still expansion. Jeff, that's it from me. I had a great time. I was very happy to be doing this again. We had a couple of weeks off. Any final thoughts for you? Any summary ideas? Anything that I can ask David to draw that comes into your mind? What's the theme of the show?
The theme of the show, I think, is what you just said. That,
oh, good.
With reopening and recovery and everything that's supposed to be going right, we should have everything all on the one side of the ledger. Yet we keep uncovering all of these things that are on the wrong side of the ledger, or maybe not even on the wrong side of the ledger, but moving in the wrong direction when they really shouldn't be. And of course, that's completely consistent with what we're seeing in bond markets and money curves and all these real-time indications, which suggest that whatever was going right earlier in the year, there's more that potentially that could go wrong, or if not even actually going wrong at the current time, that maybe we appreciate. And that, when you put that into the inflation deflation debate, inflation, which never really got to be much of a chance to begin with, judging by the bond market curves and things like that, is now almost completely written off, and where there's more of a chance of disinflationary, deflationary outcomes in the not just distant future like we've seen, but maybe into the near and intermediate terms as well. Yeah, take care, Emil. Good to be back finally again. Yeah, I forgot how to do this. Do we know what we're doing? Do we need a practice cycle?